As the coalition weathers its winter of discontent, it's rolled out policy after policy designed to bring down the cost of living, though none of it promises quick relief. This week it finally received some outside help. Amongst the gloom, a glimmer of sunlight. A Reserve Bank rate cut.
Today is a good day.
Good news today.
It's a great day for New Zealand.
They said they would fix the cost of living. Things have got worse. New Zealanders are waking up to this.
Kia ora, ko Craig McCulloch aho, and e te purongo tōranga pū mō tēnei wiki. Welcome to Focus on Politics. There's no escaping the tough times right now. This week alone saw the retailer Kitchen Things go into receivership, and Wellington's hire master shut up shop. Halt announced a proposal to close its Eves Valley sawmill, the largest in the South Island. And all the while, the cost of living crisis continues to bite. Newly released stats show food prices up 5% in the past year. Here's Westpac economist Satish Ranchud.
This is adding to a picture of a lot of pressure on many households' incomes. It's especially concerning for those households on lower incomes who are spending more of their income on food, and it's important that it's coming through on those staple items like dairy and meat.
Indeed, the pain is compounded by the fact it is the basics that are up the most. Milk up 16% in a year, butter 42%, cheese 30%. And beef mince up nearly 20%.
Butter's $10 for half a kilo, mince is $20 for a kilo. They're the same bloody price. You milk a cow and it's worth as much as the cow chopped up. This is ridiculous. Land of milk and honey.
Because you can buy $10 noodles and it'll be like 4 meals. But one mince is like 1 meal and it's like the cost of McDonald's. Like honestly, I'd rather buy McDonald's because it's cheaper and easier. But
usually I just get a big bag of sausages. I mean, it's $13 for a big bag of sausages and I can stretch 3 meals out of that as opposed to 1 packet of mince. It's shocking.
The mince misery recalls last month's butter brouhaha, another symbol of struggle for Kiwi families putting food on the table. As well, it illustrates that double-edged sword of New Zealand's economic recovery and the supposed two-track bounce back. Those high commodity costs might be hurting at the checkout till, but it's good news for the primary sector. For farmers, like sheep and beef farmer Alistair Smith from northern Manawatu.
I've only got to walk around the meat section of a supermarket and I'm shocked at how expensive it's become. But hopefully, traditionally, farming will lead the country out of a recession. When farmers get a surplus, this will flow through to the towns. You know, the farmers will go to town, buy a new motorbike or buy something for the farm. The spending will come through to the farm and they'll ultimately improve employment in the towns and cities.
That is the plan and the government's hope, but it doesn't make it easier in the meantime. New figures out from Infometrics this week drive home that two-speed turnaround, with different parts of the economy moving at vastly different paces. It's the rural areas driving growth, but the big cities lagging. In Wellington, employment was down 3.1% on the year before, and in Auckland, 2.1%. That's 18,000 fewer jobs in the city of Sales than a year ago. Infometrics highlights the weak construction sector as one of the driving problems. And on Wednesday, Fletcher Building described 2025 as one of the most demanding years in recent memory. It reported a net loss of nearly $420 million in its latest year, worse than last year's loss of nearly $230 million. And smaller builders like Steve Brown in Auckland are feeling it too.
This is probably the worst I've ever seen it. You go back to, 2008, 2009, that financial crash, that happened overnight, right? That was pretty scary, but it was over and done with within a year, so the thing we're back up and rolling, but this has rolled on to years now.
No doubt the construction downturns contributed to Carter Holt Harvey's plan to shut its sawmill near Nelson too. Certainly, the bad news came as no surprise to the Timber Industry Federation's Executive Director, Jeff Eilott.
Building consents have dropped from 51,000 issued in 2022, and that's down to around about 34,000 this year, the year to June. So it's pretty easy to see why sawmills are struggling at present.
Right. So about 20,000 fewer homes being built. What are the other factors at play here in terms of what's going on in the timber market?
Similar to, your average household, Ingrid, we're facing massive increases in electricity prices. Last year was particularly bad. Insurance costs are on the rise. Seems to be a never-ending string of compliance requirements that industry as a whole is facing in New Zealand at the moment.
On that last point, this week the coalition moved. On Monday, the Prime Minister Christopher Luxon unveiled what he billed as the biggest change to the building consent system in decades, a shake-up designed to reduce delays and to stimulate the building sector.
We are determined to get the building and construction sector firing on all cylinders, and that requires bold change.
Making common sense reforms like these to supercharge building in this country is an important part of this government's economic growth plan.
The major shift relates to liability, that is, who is held responsible when a build goes wrong. Right now, it tends to land fully on the councils, which the government says has resulted in them being overly cautious and slow to sign off on work. The government is changing that, so the responsibility will be shared across all those involved, including the builder. There's a lot of detail yet to be worked through, and questions over whether it could expose homeowners to more risk. But broadly, there's cautious support, including from the opposition Labour Party and its leader Chris Hipkins.
The current rules were introduced following the leaky building saga because people ended up with these leaky homes and no one ended up carrying the liability for that other than the homeowner. And so that's why the rules are as they are now. Can they be improved? Undoubtedly, yes. Are they slowing things down? Yes, they probably are. So I think the government are making the right steps. They're heading in the right direction. The issue will be getting consumer protection right.
That conditional support will give the coalition some political cover as it works out the kinks. The same too for another policy unveiled this week, a rule change affecting the 4 big power companies, which the government hopes will eventually put downward pressure on power prices. But not in the short term. Many in the business community are calling for more action, more urgency, more vision. The past weeks have seen growing calls from Auckland business advocates for a shot in the arm, whether through a bed levy, a corporate tax cut or capital expensing. Former National leader turned Auckland Chamber Chair, Simon Bridges.
If all we worry about is the long term, I'm not sure there'll be that many Kiwis left in Auckland. It's now that they need to be focused on.
Auckland CBD's Heart of the City chief, Viv Beck.
Actually, what we do need is a game plan here.
Auckland's Mayor, Wayne Brown.
This is a third of New Zealand. This is the city that decides who's the governor.
And Sudima Hotel boss, Les Morgan.
It's just such a depressing environment at the moment. We completely agree with the Mayor that we need a shot in the arm.
As well, the right-leaning Taxpayers Union has called for an urgent mid-year budget. That building narrative will be of concern to the coalition, given both the business and Auckland communities traditionally favour the National Party. And the opposition parties sure sense an opportunity.
They said they would fix the cost of living, things have got worse. They said they would fix housing, things have got worse. They said they would fix health, things have got worse. New Zealanders are waking up to this.
So far, the coalition has resisted the pressure to change course, pledging instead to stick to its long-term plan, cutting regulations and cutting spending. On Morning Report on Monday, Christopher Luxon insisted the government was doing its bit.
It's going to be a series of lots of little things that add up to make a big difference to get investment into the city. And so
no sweeteners in the meantime for Auckland. It's wait and hope for those things to flow through.
No, it's not. We're very up for what more can we be doing. You've seen a government that responded to the April tariffs with investment boosts, with a 20% write-off of small businesses that want to invest in plant capital and equipment to be able to do that. That looks like it's had some encouraging results in the July month, which is fantastic. Fast Track, as I said, was passed, and now we've had our first project coming through. We've got 8 more, I think, potentially coming in before Christmas. We've got $6 billion of infrastructure.
Just listening to you saying all that, are these people wrong? Are they just not getting it, these people who represent business and Auckland?
No, they're reflecting actually what it is. It's really tough in Auckland and also in Wellington. There's no doubt about it.
Yeah, and they say you're not doing enough. They're not feeling as optimistic as you are about the future of the city.
Well, as I said, we're open to continuing to look at what more we can do. We're pretty dynamic and agile. We keep adjusting to the circumstances that we're in.
Dynamic and agile. The coalition stresses, however, that doesn't mean knee-jerk or panicked.
Some would say, only do what's in front of your face right now. Well, the Labour government did that, and it left us in a bad position.
The Finance Minister, Nicola Willis, this week seized the opportunity to draw a comparison between the coalition parties and those in opposition, wielding a recent report from the credit ratings agency Fitch, which confirmed New Zealand's AA+ rating but contained a warning too.
You have to read between the lines, but it's there. They said the biggest risk to New Zealand's rating and therefore our debt servicing costs is a walk away from the culture of fiscal responsibility that has characterised our country. It is very clear to me that Chris Hipkins is laying his stake in the ground, that he is prepared to walk away from that. I want to warn him against that, because every New Zealander will pay the price if a Labour Greens government puts our fiscal reputation at risk, and frankly, even if they campaign on ludicrous promises that will put New Zealand in poor standing.
Nicola Willis is speculating on what our policy may or may not be. We haven't set out a policy yet. We've got to see how much more damage she'll do in the next 12 months before we can do that.
This is a warning shot. The path that we are on is necessary.
So, no budging for now, no short-term stimulus. Not from the government anyway. Instead, it's clear the coalition is relying on that stimulus coming from elsewhere, primarily from the Reserve Bank, primarily through interest rates.
The simple fact is, if the government were to embark in a large fiscal stimulus right now, that would be the end of interest rate reductions. And I'm concerned that without dropping interest rates, we won't see the revival we all wish to see in the construction sector, in our business sector, all of the private industries that rely on being able to borrow in order to generate the growth that New Zealanders need.
And right on cue, the Reserve Bank did just as had been expected and hoped. On Wednesday, it cut the official cash rate down 25 points to 3%.
Kia ora koutou katoa, nō mai haere mai, welcome. We're here to discuss this, the August monetary policy statement, just checking you're in the right room and on the right channel.
The cut had been entirely expected and priced in by the market, but the commentary which came with it carried some surprise. The Governor, Christian Hawkesby, signalled there were likely 2 more cuts to come.
If medium-term inflation pressures continue to ease as expected, there is scope to reduce the official cash rate further.
Back at Parliament, the government MPs could barely contain their glee.
Madam Speaker, today is a good day. We have good news for every New Zealand household and business that their mortgage rates are coming down.
Good news today. 3% is the official cash rate. Interest rates are coming down. The stimulatory effect for our New Zealand economy is going to be great.
It's a great day for New Zealand.
We are getting New Zealand back on track, sir.
The coalition's hope is that the OCR cut will flow through to lower mortgage rates, which many homeowners will then roll onto over the coming months. That is where the direct relief will come, not through the government's actions, but through the Reserve Bank's. The Prime Minister and Finance Minister called a media conference to tout the latest development.
If you're a homeowner in New Zealand, you're going to have more money in your back pocket, and of course that's money that you can spend in the economy. Likewise, if you're a business owner, that means that you can borrow to invest and to grow your company and to continue employing people. We have about 40% of people in New Zealand that will be refinancing their mortgages in the next 6 months, so they will really start to feel the benefits of those lower interest rates.
I'd also highlight that for those with a mortgage, the interest rate reductions that have occurred under our government are really significant. For someone on a $500,000 mortgage on a floating rate, they would now be paying $330 less a fortnight to service that loan than they were a year ago. So that is significant.
There is some nuance to the numbers though, and plenty of caveats. It's worth remembering the obvious. Not everyone has a mortgage. Renters, or those with paid off homes, are not likely to notice much difference. And other homeowners will take this opportunity to pay down debt quicker. Good for them, not so much for the economy. As well, the optimism papers over some of the more gloomy aspects of the Reserve Bank's full report, and the fact the steeper cuts are coming because the economy is doing worse than it had expected. The central bank expects inflation to tick up to 3% in the near term, while wage growth is assumed to decrease. Unemployment's picked to stay above 5% until December 2026.
I'm always conscious that households listen to merchants of misery every day, most of whom sit on the opposition
Very
benches,
poetic language you use.
who like to be doomsayers and talk down the New Zealand economy. Now is not the time to be talking down the New Zealand economy.
Of course, Nicola Willis has a vested interest in talking that economy up. Looking at the cold numbers, the picture is mixed. But economists do think next year looks a little brighter. Here's Cotality's chief property economist, Calvin Davidson, on Morning Report.
From my perspective, I think we've got a few tougher months to get through, and maybe we get to the new year and that triggers a psychology change. It's not scientific.
Well, I know. I mean,
like
rolling out the barbecue on with the first couple of weeks of daylight saving can have an impact, right? I mean, sunlight.
Yeah,
it sounds silly,
that's right. That's right, yes. And obviously in the housing market, it is measured by the seasons in some ways, and that can spill over to broader psychology, I think, too. You get into spring and maybe feel a bit happier about things. So hopefully, I mean, as I say, that's not particularly scientific, but we've got to look for any sort of silver linings, I guess.
National is definitely looking for those silver linings. With polls showing the right and left blocs in a near deadlock, the coalition desperately needs that cost of living to ease before next year's election. National knows its electoral prospects are directly tied to the economy, still limping along, battered by Donald Trump's tariff regime and global instability. The big question remains exactly when. When will the economy feel healthier? When will people's lives feel easier? When will that winter start to thaw? And will it happen far enough out from Election Day? That was Focus on Politics. I'm Craig McCulloch. Thanks for joining me. Matua.